From the morning reading, corporate insiders in the energy sector have dried up their selling activity while making some buys. At the same time, sentiment on crude oil has soured to one of its worst levels in over a decade. When we've seen this kind of difference in opinion between insiders and the public, energy stocks have consistently rallied. Investors have stepped up their selling of commodity funds. In the past week, GLD has shed $784 million, equating to more than 3% of its assets. That's the largest weekly outflow since July 2013 and ranks in the bottom 2% of readings in the fund's history. When such a large flow comes after a big move, it tends to be exhaustive. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:17 a.m. Central Time, and I'm recording this in preparation for the market day of July the 24th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in and see what we've had in our overnight action. Well, slightly bullish. NASDAQ the most bullish. Obviously, Amazon had a huge earnings win last night, and if I saw the quick numbers right, it may have been the first time that they had positive earnings. This is a company that has had enormous growth, but hasn't actually made money up to, I think, the present. I may be wrong on that, but I think one thing that is a fact is the fact that Amazon is up really big last night, and that certainly is probably what's pushing the NASDAQ here. So all four broad market indices are up. NASDAQ up the most at about 0.25%. Crude oil up about 0.5%. Euro down 0.38. Bonds just up a little bit, about 0.14. Gold, though, taking a hit again, down 1.4%. In overseas action, Asia, China down 1.3%, Hong Kong down over 1%, Japan down about 2/3%, while Germany is scratch and United Kingdom is just above scratch. In terms of macroeconomic reports for today in the U.S., flash manufacturing PMI, that'll occur during the market, and also you have new home sales also occurring during market hours. In terms of current volatility, the short-term VIX is down to 11.91, and given that we've had basically 3 straight days of weakness, pretty remarkable that there's not been any more volatility come into the market than we have. But one cautionary is the skew. The skew is now up over 130, and 135 is considered a dangerous number, and an expectation that you're going to have a significant sell-off. So this has been creeping up in recent days. So while the VIX hasn't been pricing in much, the skew certainly seems to be bringing in, something of a warning sign. IV percentiles only 7 on the S&P, 16 on the Russell, 13 on the NASDAQ, and 27 on the Dow. We did have standard deviation moves put on 3 of the 4 indices yesterday, everything but the NASDAQ, which, interesting enough, had been the more active one in terms of big moves of late. Very typical kind of profile at this point, 4 days in the last 2 weeks for standard deviation moves. So can't say that this is, with the exception of the NASDAQ, anything exceptional. If anything, it really, if you take a look at the charts, it's just a very typical kind of move from the bottom of the range to the top of the range and then rolling over from there. As for how much farther this might go, we'll certainly be watching for that. There's, after 3 straight down days like this, you start to expect something of a bounce, very much like perhaps this action here, or well, maybe this action here. But normally after you have 3 straight down days, you get something of a bounce. So take a look and keep an eye out for signs of that. But as for where we go from here, we're basically about the middle of the range. So I really wouldn't say there's much in the way of pot odds as to which way we go, and you should probably treat it as trading in the middle of the range and nothing more, nothing less. In terms of the Russell, quite a bit of weakness there yesterday. You see a bearish engulfing. I mean, that is the very definition of a bearish engulfing candle. So it would seem to say that we're going to have more weakness on the Russell. NASDAQ, of course, will be driven by these earnings. While yesterday's candle mostly driven by previous day's earnings with a couple big companies coming in, and again a bearish engulfing there. So obviously big drive up on the Google earnings and other earnings, really driving this this tech-heavy index. Likely to see some more ripping going on in the NASDAQ today. And Dow continues to be perhaps the weakest, but again probably looking much like the S&P for something of a bounce here pretty soon. Let's take a quick look at transportations. Look at just how weak that is. I heard somebody talking about this one yesterday, and just about everything in the transportation sector looked ugly yesterday. And when you look at the Russell, when you look at the transportation, it's hard to make a case for a healthy bull market. These are the kinds of things we look for as signals as to what might be going on in the bigger market picture. In terms of our big picture from our daily report, we're still looking at phase 2, trend breaking. We obviously have established the higher high, but we still need a lower high, and obviously that could come at any time if we get that bounce and we establish something of a swing low. IBD status is in confirmed uptrend with a rather poor accumulation distribution scores. I told my wife last night this may be the ugliest confirmed uptrend I have seen in quite some time. Ever since we got the confirmed uptrend signal, we essentially have achieved nothing. And at the same time, we have some really, kind of ugly internals to all this. But accumulation distribution on the S&P D minus, NASDAQ D plus. We do have a buy signal on the GMI index, so it also agrees with what IBD is saying. Decision Point also has buy signals across all 3 time frames. Intermediate term market posture, very bullish. Position sizing opinions from both metrics are at 100%, and indeed if you look at the market posture, very bullish. S&P 84, very nicely scored there. NASDAQ almost an 89. However, Dow is bearish at a 65, and Russell far more bearish at a 44. When you put all this together, we currently have a continuing threshold level of 0 plus, which is normal with cautionary aspects. In terms of volatility-based metrics, everything was pretty clean, but this one, S&P added to its distribution day count, and that's one of the things I was referring to when I say this may be one of the ugliest confirmed uptrends we have seen. To have these kinds of distribution day counts with an association of a bull market orientation is just not very clean at all. NASDAQ also at a 4. That by itself isn't that bad. It's kind of on the upper end. We get a little bit more concerned when these counts go over 5. But it's hard to believe that we're going to have, the next big leg up in terms of bull market when we have a distribution day count of a 7. You have, of course, that skew I mentioned up over 130. Also, look at this. New York Stock Exchange, new high, new low. We've been seeing this for several days now. We've been talking about how breadth is so narrow and that a handful of companies are driving these new highs and that many stocks are not participating. If you look at the percentage of stocks above the 50-day moving average, above their 100, above their 200, it's very poor percentages. And indeed, yesterday, 579 stocks on the New York Stock Exchange put in new monthly lows. In terms of the risk aversion indicators, you have 2 as risk off, 1 as risk on, but looks to be perhaps rolling over, and then 2 that are still risk on. So this also is an area of concern. Overall, though, the level of concern isn't that significant and probably best expressed by position sizing adjustments. Option income strategies of VIX is inside the acceptable window. Conditions are acceptable for new positions. But consider, since we are down near 12 on the VIX, the potential for increased volatility, and given the poor follow through on this range action, always consider that volatility could really step up, and you might want to consider that in your position sizing. Other than that, obviously, if we stay in range-bound activity, option income strategies may be the best strategy for right now. Covered call strategies, conditions are acceptable to initiate new positions. Consider a one-for-one distribution between in-the-money and out-of-the-money strikes. Very poor follow-through. I closed a position yesterday to where, the entire profit came from the selling of the covered calls, and the in-the-money versus out-of-the-money distribution absolutely made the profit for the strategy. The underlying stock really had gone nowhere. I closed it because we had upcoming earnings instead of rolling out another month. So it did what it was supposed to do, made a nice little profit, pocketed that, got out. And I'll look to reset, after that earnings if the conditions are still, hitting my metrics with that stock. But the point I'm trying to make here is that this one-for-one distribution, this was the source of the profits in this current range-bound activity. And this was despite a company that, scored very highly, should have been, all-world kind of growth. Well, in this current market condition, very, very good companies don't necessarily follow through to the upside, or they follow through in a stunted way. So one of the benefits of the covered call strategy is its ability to be more defensive in nature and bring in a steady stream of income at the same time that the market is not exactly rewarding those in the traditional buy and hold of stock positions. Put selling conditions are acceptable for new core put portfolio positions. Just keep in mind that you want to kind of pick your plots, and we're still range bound. In terms of sector specific, not a very pretty picture here, but we continue to see healthcare, staples, discretionary, financials, the same four we've been talking about, still doing well, and others that have not been doing well still are not, and that would include energy and materials for sure. Very red day yesterday, and obviously the third day in a row. Now you look at the week and the 1 month and even the 3 month and year to date, it's not a very pretty picture out there on most sectors. Healthcare probably, and you see this 1 day and 5 day just marginally down. But even when you start stretching back, the 1 month and 3 month aren't exactly on fire, though the year-to-date performance in healthcare is certainly the strongest. Second strongest, consumer discretionary, and those should be the two sectors that are probably watched, number one and number two. Okay, should be enough for today. As always, if you find this helpful, we greatly appreciate you retweeting us to your Twitter followers or your stock twit followers, liking us on YouTube, subscribing to us on the YouTube channel, all those kinds of things. Give us that feedback that we like to hear, that people out there are finding this a useful effort, and we should continue to do what we're doing here. Other feedback can be sent to support@falconglobaltraders.com. More information about what we do, certainly this website can give a lot more detail. Disclaimers as always. Hit the pause button if you need more time to review this. And we'll see you back here on the very soon with the market preview. Good trading.